What if I told you there's a completely legal way to live like royalty, pay almost nothing in taxes, and then, when you die, pass the whole thing to your heirs with the IRS barely touching it? You'd probably assume I'm pitching some offshore nonsense, Cayman Islands, shell companies, a scam with a webinar at the end. But that's the part that should bother you. This isn't tax evasion. It's not hidden. It's not exotic. It's been sitting inside the U.S. tax system for generations. So simple a law professor had to give it a 3-word nickname just to make people see what was happening. My name is Nick, and I spend an unhealthy amount of time studying the financial strategies that separate the wealthy from everyone else, especially the ones that aren't hacks, but policy outcomes. If you've ever watched a headline about billionaires paying lower rates than teachers while you're getting crushed every April, you're going to want to understand this. Subscribe if you want more breakdowns like this, because once you see the mechanics, you can't unsee them. The strategy is called buy, borrow, die. And before you roll your eyes, no, this isn't a get-rich-quick plan. You can't do this with a few $100 in your checking account. This is a wealth preservation machine that only starts working when you already have serious assets. But understanding it will change how you think about taxes, investing, and why rich people seem to live by a different rulebook. The phrase was popularized by USC law professor Edward McCaffrey in the mid-1990s, not as a cheat code for the rich, but as an explanation for why the tax system can feel fundamentally unfair. For years, people treated it like an oversimplification. Then, in 2021, a major investigation using leaked IRS data put the spotlight on what McCaffrey was describing. The wealthiest Americans weren't just paying lower rates. They were often paying shockingly little relative to how fast their wealth was growing. Here's the key. Buy, borrow, die doesn't rely on breaking rules. It relies on using the rules exactly as written, just in ways most people never get the chance to use. So let's break it down. Because once you understand the first step, the buy, you'll see why everything else becomes possible. The buy phase starts with a choice most people can already afford to make. Instead of building wealth through taxable income, wealthy individuals load up on assets that quietly appreciate and until generate much taxable income along the way. Growth stocks, real estate that rises in value, private company shares, art, anything that can climb for years in the background. And here is the engine of the whole strategy. As long as you don't sell, those gains aren't taxed. The value can rise for decades while the tax bill stays at zero. Because on paper, nothing happened. As long as you don't sell, the government can't touch the gains. Your net worth can climb for years, sometimes decades, while the IRS just watches from the sidelines because on paper you haven't made anything, not in the way the tax code recognizes. Now compare that to how most people build wealth. You work a job, you get a paycheck. And before that money even hits your account, it's getting shaved down by income tax, Social Security, Medicare, maybe state tax too. Then you try to invest whatever's left, retirement account, house, maybe a brokerage account if you're lucky. The wealthy flip that sequence. They start by owning assets. They let those assets grow. And then they figure out how to use that growing wealth without ever doing the one thing that triggers taxes, selling. And at this point, a reasonable person asks the obvious question, okay, how do you live off wealth you never cash out? You can't pay a mortgage with unrealized gains. The grocery store doesn't accept stock certificates. At some point, you need spendable dollars. That's where phase 2 comes in, and it's the part that makes buy, borrow, die feel like it was built in a different universe. Step 2, borrow. Once you own a large pile of appreciating assets, you don't just hold them, you use them as collateral. Big banks and wealth management firms offer products designed for this exact move, securities-based lines of credit. You pledge your investment portfolio, and the bank gives you cash without you selling a share. And here's the tax trick hiding in plain sight. Borrowed money isn't taxed. If you borrow $1 million against your portfolio, that million shows up in your bank account as spendable cash, and the IRS treats it like it never happened. So the rich can fund their lifestyle, homes, cars, tuition, vacations, even new investments, using money that doesn't count as income. Now, borrowing isn't free. You pay interest. But wealthy borrowers typically get better terms than almost anyone else, because to a bank, a client with a huge portfolio is low risk and highly profitable. Depending on the assets, lenders may offer something like 70-80% of the portfolio value as a credit line, sometimes more for very stable collateral like treasuries. And the bigger your portfolio, the more you can negotiate the rate. Here's the part that turns this from nice perk into a compounding machine. While you're borrowing against your assets keep growing. So if your portfolio is rising at, say, 7-8% a year, and the interest on your loan is lower than that, you can live on borrowed cash while your net worth still climbs in the background. Over time, it can become a loop. Portfolio grows. Borrowing capacity increases, you refinance or borrow more, portfolio keeps growing. It can feel like a perpetual motion system. Liquidity without selling, spending without taxable income. And at this point, you're probably thinking what you should be thinking. This sounds too good. Where does the bill show up? What happens when markets fall? What happens when the bank wants its money back? What happens when the debt pile gets massive? That question is exactly why Phase 3 exists, and it is the part that makes this strategy so powerful across generations. Step 3. Die. The die part isn't just dark branding, it's the handoff. When someone using this strategy passes away, their heirs inherit the assets under a rule called stepped-up basis, and that S, where the tax system treats decades of growth like it never happened. This is where the tax code hands the wealthy a gift most people don't even know exists. Under current federal rules, when you inherit an asset, you don't inherit the original purchase price. You inherit the asset at its current market value on the date of death. That's called stepped-up basis, and it's the reset button that makes buy, borrow, die work as a multi-generation machine. So imagine your grandmother bought a stock for $10 a share 50 years ago. Over time, it climbs to $500. If she sold it while alive, that $490 gain would be taxable. But if she holds it until death, you inherit it as if she bought it at $500. On paper, the gain disappears, not because the stock didn't go up, but because the tax system pretends the starting line moved, which means the heirs can do something insanely clean. They can sell right away, pay off any outstanding loans tied to the strategy, and, at least from a capital gains perspective, owe little to nothing on decades of appreciation. The wealth doesn't just survive the handoff. In many cases, it shows up on the other side stronger, because the biggest tax liability got erased at the moment of transfer. And that's why the numbers behind this strategy feel like they belong in a different economy. So let's make it real with an example. Meet Maria. Maria is a successful entrepreneur. Over years of building and selling businesses, she accumulates $1 million. Now, Maria could do what most people do when they come into serious money: upgrade the house, buy the cars, take the trips, and slowly watch the pile shrink while taxes take their bite whenever she realizes gains. But Maria plays the game the way wealthy families play it. She doesn't treat the million like spending money. She treats it like the seed of a system. Maria invests it in a diversified portfolio designed for appreciation, not income. Growth-oriented stocks, real estate exposure, private equity, assets chosen specifically to climb without constantly kicking off taxable payouts. She's not chasing dividends. She's not trying to maximize cash flow. She's trying to maximize silent growth. Now watch what happens. Assume the portfolio grows at a conservative 7% a year. After 10 years, that $1 million becomes roughly $2 million. That S close to a $1 million gain, and she hasn't paid a cent in tax on it because she hasn't sold. If Maria cashes out now, she triggers the event the whole strategy is designed to avoid: a taxable sale. Depending on where she lives and her tax situation, she could face federal long-term capital gains, potentially the net investment income tax, and state taxes. It's not hard for a meaningful chunk of that gain to evaporate, but Maria doesn't sell. Instead, she walks into a private bank and does what the buy phase was setting up the entire time. She uses her portfolio as collateral for a securities-based line of credit. If the bank is willing to lend up to 70% of her portfolio value, Maria can borrow about $1.4 million without selling a single share. Now she has spendable cash, and because it's a loan, not income, it arrives in her bank account untaxed. The interest rate in a modern environment might be something like 6.5%, and so on $1.4 million, she's paying around $91,000 a year in interest. And here's the comparison that makes the strategy click. Sell the assets, and you can trigger a massive one-time tax bill. Borrow against the assets, and you pay a smaller annual cost while keeping the portfolio intact. But it gets even more powerful, because while Maria is paying interest on the loan, her underlying portfolio is still invested. It's still growing. If Maria's portfolio earns 8% a year and her loan costs 6.5%, she's not just getting away with something, she's running a spread. On a $2 million portfolio, 8% growth is about $160,000 in a year. On a $1.4 million loan at 6.5%, interest is about $91,000. So, in this simplified example, Maria S. net worth is still climbing by roughly $69,000 a year. While she is living off cash she didn't have to realize as income. That's the psychological whiplash of this strategy. Most people have to choose between investing for the future or selling something to fund their life today. Maria doesn't. She gets to do both. She can buy a home, fund a lifestyle, invest in new ventures, whatever, and none of that borrowing shows up as taxable income. Meanwhile, her portfolio stays fully invested, still compounding in the background. And the longer time passes, the stronger the machine gets. Because as the portfolio grows, her borrowing capacity grows with it. She can refinance, she can expand the credit line, she can roll old loans into new ones under better terms, especially as her relationship with the bank deepens. That's the loop. Assets rise, credit expands, cash arrives, Assets stay invested. Assets rise again. Now, let's be clear, it's not risk-free. If markets drop hard, lenders can demand more collateral or force sales. If rates spike, the interest cost can jump. You're basically swapping tax risk for leverage risk. But for people with enormous portfolios, and banks willing to treat them like VIP borrowers, that trade-off can still be worth it. So naturally, you're thinking, okay, fine, borrow against assets, live large, keep compounding. But where does the debt go? Because eventually, the loans come due, and at some point, Maria dies. Wouldn't her estate have to sell assets, trigger taxes, and finally pay the bill? This is where the final phase makes the whole thing click. The handoff. Fast forward 30 years. Let us say Maria EF's portfolio grows from 1 million to 8 million over decades of compounding. Along the way, she's stacked up several million in loans, big lifestyle funding, refinancing, maybe expanding credit as the portfolio rises. But her assets outpaced her debt, and then she passes away. Her heirs inherit the portfolio under stepped-up basis rules, meaning the cost basis gets reset to the market value at the time of death. So all those decades of appreciation, from 1 million to 8 million, Donna T, come through the inheritance as taxable capital gains sitting on the books. The tax system effectively redraws the starting line. Now imagine Maria's heirs need to settle the outstanding loans. They can sell, say, $4 million worth of inherited assets, pay off the debt, and because the basis has been stepped up, the capital gains bill can be minimal, sometimes effectively zero, even though the family just cashed out millions. What's left? Maybe the remaining $4 million becomes their inheritance. Put that in perspective. Maria started with $1 million. She lived for decades with access to tax-free liquidity through borrowing. And her family still walks away with millions, without ever paying the kind of capital gains bill a normal investor expects when an asset multiplies in value. Meanwhile, if you build wealth the normal way, earning taxable income, saving after-tax dollars, selling investments when you need money, you get taxed at every step. And here's where this stops being a neat story about one hypothetical entrepreneur and turns into something bigger. This isn't a trick a few families discovered on Reddit. It's a massive industry. Securities-based lending has become a standard feature of private banking and wealth management. Major institutions package these credit lines as normal products for high net worth clients. And the thresholds tell you everything. At many firms, you don't even get invited into this world until you have roughly $1 million in investable assets. Premium tiers can start at $5 million or $10 million. Once you're in, banks compete for you because wealthy borrowers are sticky clients who generate fees, interest, and long-term relationships. And as your wealth rises, your borrowing terms often improve. These loans are typically priced off benchmark rates. Today, you'll see benchmarks like SOFR, depending on the institution, plus a spread. The spread tends to shrink as the relationship gets bigger and the collateral gets safer. Translation: the system doesn't just let you borrow against wealth. It often gives you a better deal the richer you are. Someone with a $50 million portfolio can frequently negotiate rates and terms that a $5 million client simply can T. Same product, different universe. And that's why buy, borrow, die scales so brutally. The bigger the portfolio, the cheaper the money, the easier the liquidity, the longer you can delay selling, and the more powerful that final reset becomes. Here's the part that's almost impossible to unsee once you recognize it. The system rewards you for already being rich. Over the last few decades, the menu of things you can borrow against has expanded way beyond plain stocks and bonds. Traditional public portfolios were always the cleanest collateral, but now private banks and lenders will lend against more of the rich people asset list, private equity positions, hedge fund interests, certain real estate vehicles, sometimes even high-end collectibles and art under specialized arrangements. In other words, the financial industry didn't just notice buy, borrow, die. It built infrastructure around it. And the reason it works isn't complicated. It scales. If you have $10 million in assets and a lender is willing to extend a credit line around 70%, you're suddenly sitting on roughly $7 million in spendable liquidity without selling. If you have $100 million, that becomes $70 million. Same strategy, same mechanics, different planet. The more wealth you have, the more safely you can use leverage, the better terms you can negotiate, and the easier it is to keep the machine running without ever needing to sell. And that's where this stops being a clever tactic and becomes a generational engine. Because once the cycle repeats across decades, you don't just preserve wealth, you create dynastic wealth. Each generation inherits assets with the basis reset, continues borrowing against growth, and hands off an even larger pool of assets to the next generation. Taxes keep hitting paychecks. Taxes keep hitting spending. But this strategy sidesteps the one tax that supposed to hit huge increases in wealth: the tax on realizing gains. Meanwhile, Families building wealth the normal way, earning income, paying taxes immediately, saving what's left, can face combined tax burdens that feel punishing when you stack federal, state, and payroll taxes. And that gap in treatment helps explain why wealth inequality doesn't just persist, it compounds. Because you can't tax wealth that never shows up as income. And you can't collect capital gains tax on assets that never get sold. So when people say, just raise the tax rate, they're often arguing on the wrong battlefield. Politicians fight about marginal rates and capital gains percentages, like the wealthy are sitting there waiting to be taxed. But for someone playing buy, borrow, die, the tax rate is almost beside the point, because the strategy is built around not triggering the taxable event in the first place. You could raise capital gains taxes tomorrow, and the person who never sells still isn't a UET paying capital gains taxes. That is how you end up in this surreal situation where a middle-class household earning $60,000 can feel every tax immediately, while someone controlling billions can report little taxable income, despite their wealth ballooning year after year. The nurse, the teacher, the engineer, the small business owner, they get taxed in real time, income, payroll, property. Then they watch headlines about billionaires paying a tiny fraction compared to how fast their fortunes grew. And what makes this even harder to swallow is how often the conversation gets framed. The financial media will happily publish endless tax tips for normal people. Little deductions, little credits, ways to save a few $100, while barely touching the structural strategy that can erase decades of gains. At the same time, wealth management firms market securities-based lending like it's a luxury utility. The language is always soft and sterile. Tax-efficient liquidity. Wealth optimization. Maintain your positions while accessing capital. Translation: keep the assets, take the cash, avoid the sale. And here's the bigger consequence most people miss. Buy, borrow, die doesn't just affect taxes. It affects markets. Because when your plan is to never sell, your behavior changes. You don't think like a normal investor trying to take profits. You think like a holder whose main goal is to accumulate assets and keep them indefinitely. Traditional market logic assumes that eventually gains get realized and assets return to the market through selling. But if the largest holders treat assets as permanent collateral, something you borrow against instead of cashing out, then a meaningful chunk of the supply stays locked up for longer. That can create a kind of quiet scarcity. Fewer sellers, more holding, and persistent upward pressure, especially in assets that wealthy investors concentrate into. And that's the final punchline. Buy, borrow, die isn't a conspiracy theory. It's not a loophole somebody discovered last year. It's a legal structural strategy built into how appreciating assets, lending, and inheritance interact in the U.S. system. It lets the ultra-wealthy live off liquidity without income, keep compounding without selling, and pass the whole thing on with a tax reset at the end. And once you understand it, you understand why the richest people can pay lower effective rates than people who actually work for a living. The game wasn't just tilted. Most of us were never even taught what game we were in.